Well, I like to point out the estimates are you could drive a truck through them, 10 to 15 million barrels per day. But I think what everybody appreciates at this point right now is they're just too little too late. Satellite data suggests there's a tsunami of oil going into tank right now of excess of 20 million barrels per day. So if you're talking a cut of 10 to 15 and the surplus is 20, you really can't do anything about it. We think the loss in demand is probably like 26 million barrels a day right now. And I think the key point here is to remember that oil sits in the crosshairs. Why? Because it creates social contact and it creates globalization, the two things we're trying to stop. And so in that context, I think you look at the way the market's trying to price it, it's pricing in a significant disappointment. You see it in the put spreads.
Yeah, I mean, oil really hasn't been the same since Joe Kernan's report and then moments later the president's actual tweet. So are you suggesting that what the optimism that came into the market from the president's tweet was not well-founded?
Well, let's look at where cash prices are trading right now. I think that's the key point. Crude in Canada, $13 a barrel. Crude at Midland, $21.50. Even the Brent cash price is trading $6, $7 on your screen. So your screen says 32, 33, but the cash is sitting anywhere from $6 to $7 a barrel lower. And I think the key point here, the cash markets don't lie. The cash is not looking towards any type of resumption of this current surplus. It's only being priced in the forwards.
Yeah, we're looking at WTI at 26. Joe, you have something for Jeff Currie?
I do, Jeff. I'm just wondering, how much of a discount in the price of oil do you think there is that will actually return when we see the demand evaporation dissipate and the economy is opened once again?
Our target for next year is $55 a barrel. But I think the key point in terms of thinking about, the upside here is that the return in supply, because we're going to have to shut in a lot of production globally, the return in supply will be L-shaped. The return in demand is V-shaped. You can think about all you're going to do is go out into your driveway, get in your car, and start driving. However, when you shut in wells due to hitting logistical constraints around the world, because think about that tsunami of oil that's going through those pipelines, it's going to create congestion, just like you see on the freeways. That's going to stop up the ability for oil to move. They shut in that production, and in some cases, you're going to do damage to that production where you can't bring it back online. And so when we think about that outlook, when the system starts to normalize, and I don't want to speculate when that can be, you're going to end up with a sharp rebound in demand, and supply is likely to lag. Just one quick point on that is when you think about the risk around OPEC cutting, we're trading June barrels right now. And if you use the Chinese prototype for Wuhan, we could be normalizing by June.
Yeah, I mean, if the economy gets into a reopening process anytime soon, what potential dollar amount does that mean for your forecast?
We're trading somewhere around let's take Brent, somewhere around $30 a barrel, and we could push this thing up $10, $15 a barrel once you start that process. But I think that's our outlook towards 6 months. I just want to be absolutely crystal clear here. I don't have a crystal ball that I can look into and be comfortable about when that normalization process. We do see positive events in terms of looking at the viral infections. However, how do we all return to work is still a big question mark.
So you're being especially tactical in the way you're looking at the price of crude oil, maybe in a way that I'm not suggesting that you don't normally do that. However, because there is no visibility on the other side or when the other side can first be walked on, you're having to make these especially tactical calls because that's all you have to work with. Am I right?
Yeah, well, let's also think about the difference between commodities and equities. Equities are anticipatory assets. They anticipate the future. Commodities are spot assets. The price of oil has to clear the supply and demand of today. And we look at where those cash prices are. They're telling you the situation is relatively bleak today. And then each one of those forward prices are connected to that cash price through a cash and carry arbitrage. So commodity markets can't get too far out of line from current fundamentals or you get in trouble. And right now, you look at that spread between cash and where those futures are, it's at, what I would argue, relatively dangerous levels.
Always good to check in with you, Jeffrey. Thank you for coming back. We'll talk to you soon. That's Jeff Currie from Goldman Sachs.